Hi, welcome to the final episode of the AJ Bell Money Markets podcast for 2025. I'm Dan Coatsworth, and joining me this week is Tom Sieber. Hi there, Tom.
Hi, Dan. Great to be on the pod again.
So, on this week's episode, we're going to talk about problems on the high street for one well-known retailer, what the latest UK economic data is telling us, and Tom's got a wheelbarrow full of news all about the property sector to digest.
Yeah, we're also going to talk through how financial markets behaved in 2025, which stocks were winners or losers, and we'll have a chat with AJ Bell's managing director for its investment divisions, Ryan Hughes, about what he took away from 2025's performance.
Tom and I are going to talk about gold miners, banks, tech companies, advertising agencies, and probably a pint of Guinness, all the essentials.
Absolutely. And while markets have generally done pretty well in 2025, we've always got one eye on the future. And there's probably some people looking into 2026 with a little bit of trepidation. So with that in mind, we've spoken to Charlotte Yonge from Troy Asset Management about how she runs an investment strategy that has the protection of wealth at the heart of it.
Now, I'm also going to hear from AJ Bell's chief executive, Michael Summersgill, about what's needed to get more people saving and investing for the future.
Let's start with the retail sector, though, Dan. What's been going on there?
I want to talk to you about Card Factory. I guess we are, as we're recording this, we're just about a week away from Christmas. You're starting to get Christmas cards coming through your door, or judging by Card Factory's update, perhaps you're not getting them through the door. I think this is one of the things. So, Tom, how many Christmas cards have you managed to get?
Yeah, a lot less. And we've started sending them. We've really rationed the amount that we send. So none of this is good news for Card Factory on a micro level, at least.
It's come out and said that the weak high street is not being very helpful to its business. Because if you think about the average Card Factory sale, it's kind of like passing trade. You're going past its shop and think, oh, I need to get a birthday card or a Christmas card or something. So the trading's not been great. I also think there's probably an issue here where the cost of a stamp is more than the cost of buying one of its cards.
Yeah.
And also, I think, you could say, well, this is an omni-channel business. What about online? There's an argument to say, do people really go online to buy cards? I think Moonpig will give you the impression from its recent trading that it's, things are okay, but for Card Factory's online sales are very, very small. So I think overall, you've got a picture here of a business that is perhaps not doing too well. It's hard to sort of say when exactly it will be doing well. What's the catalyst to sort of trigger stronger trading in there? Definitely one we'll watch closely.
Absolutely. And while we're talking about kind of consumer spending and how people are feeling about spending their money, I noticed there was quite a big market reaction to the latest update from one of the UK cinema chains. So, Dan, can you talk us through what happened there?
Yeah, so this is Everyman Media come out with its trading update and said things are not as good as it hoped, and it blamed it on the fourth quarter cinema slate. So this is essentially talking about here is like, what are the films that came out in the last quarter of the year? If they're no good, ultimately we won't want to go to the cinema, whether it's to Everyman or another chain. So I think this is a problem we've seen time and time again with cinema operators on the stock market. It's all about what is actually being released in terms of whether they're doing well or not. Poor old Everyman, shares in the company are down by 3/4 over the last 5 years. And I just think that you've got a situation here where, say 5 years ago, it had quite an interesting position in the market. Posh cinemas, nice seats, you can eat at your seat. They'll come and serve you and stuff, food and drink. If you go to something like View now, pretty much every seat is a nice posh recliner. I'm wondering what's kind of special about Everyman now. And also you've got this debate about, who is going to buy Warner Brothers if it's Netflix? What does that mean for the future of cinema? So a tough old industry to be operating in at the moment.
Yeah, definitely. I think that's a good point that, the other operators have upped their game. And I think for Everyman to blame the kind of the film slate, I guess that obviously does make a difference, but they're selling something a bit different anyway, aren't they? So, that, like you said, that experience and being able to sort of sit on the comfy sofa, I think, it's perhaps more worrying that, they're struggling beyond just, a short-term problem because of the film slate. Now, a lot of people were nervous ahead of the budget about spending money in case the Chancellor announced some big tax hikes. And that must have had a wider impact on the economy. So Dan, could you talk a little bit about what the data has been telling us?
Yeah, so we've had some figures out about GDP, which is essentially a measure of the economy. We've had some figures out about inflation, and by the time you hear this podcast, we'll have had an interest rate decision as well. So if we start off with the GDP stuff, so the UK economy shrank by 0.1% in October. It was forecast to grow by 0.1%. So here immediately we've got disappointment. There's some blame at the cyber attack at Jaguar Land Rover continuing to affect car production in the country. Obviously, we're talking about figures from October. Lots of nervousness ahead of the budget that happened in November. Obviously, that might have hurt consumer and business confidence, might have hurt their spending patterns. So it kind of means the economy has only grown in one of the past 7 months. So not a good picture there. Come to inflation, a bit better here. So we've had falls in food, alcohol, and clothing prices last month. Actually helped drive inflation to its lowest levels in 8 months for the November reading. So inflation hit 3.2%, and that's less than lots of analysts were expecting. Lower food prices, main driver of the fall. That's really good news. Obviously, if you've been loading up for your festive activities of Christmas and you're entertaining your families and stuff. Other items which pushed down inflation were the cost of tobacco, restaurant meals, hotel stays, and transport. So obviously, when we're talking about inflation, it's really important to look at the trend, what's going on. The Bank of England has a target of hitting inflation of 2%. So inflation is heading in the right direction. Therefore, that strengthens the argument for the Bank of England not to hold interest rates as high as they have been recently. The jobs data also plays a role in that decision. So we have some figures showing UK unemployment rate rose to 5.1% in 3 months to October. And it's young people here particularly sort of affected. So now we're recording this podcast on Wednesday, the 17th of December, a day after we record this podcast, but just before you come to listen to it, we will have an interest rate decision. I think we can fairly say with confidence that the Bank of England will have announced a rate decision. If it's not, you'll probably hear a little message from Tom at the start to talk about it. But let's just say, for the magic of this recording, that they did go ahead and record stuff. So I think it's, you've got here that inflation is heading in the right direction. The UK unemployment is a bit worrying, of course. So it really strengthens the argument for the Bank of England to get those interest rates slightly lower, make it easier for people to be able to borrow money, make it easier for businesses to borrow money, and obviously if they've got existing borrowings, bring down that cost of that servicing that borrowing.
Yeah, that's all really, really interesting stuff, and it has something to do with what we're going to be talking about next. So, Dan, do you want to tee me up for my property extravaganza?
Yeah, we want to talk about property, but obviously if you think about anything to do with property, whether you're a house builder, whether you're an aspiring homeowner, what you want is interest rates to be as low as possible, because low interest rates hopefully equals low mortgage rates. More people can afford to get on the housing ladder. So Tom, we've had a load of property data over the last week or so. Should we just go through those one by one, talking about house price trends, planning reforms and stuff? What do you want to start with?
Well, let's start with those house price trends that you mentioned. So, as we discussed, the budget has had a big impact on the economy and probably sort of no more so than the effect it had on the property market. And, it had a real kind of chilling effect in the sense that transactions weren't happening because people were holding fire basically until they knew what was going to come out of the budget. That's not unheard of. That quite often happens around budgets, but the timing of the budget, which was so late in the year, certainly didn't help matters. We've just had the official figures from the Office for National Statistics through for October, and they show a 0.1% fall month on month. They do show an annual increase of 1.7%, but the really kind of telling thing from that update, I think, was the performance of the London property market. Now, interestingly, I mean, this was obviously pre-budget, but it's probably the market that was most impacted by certainly the most high-profile kind of change to property taxes in the budget, which was the mansion tax. So that's this new levy, which will see people who live in multi-million pound homes face extra council tax charges. And it was comfortably the worst performing region, by quite a distance, really. So prices fell both month on month in October and also on a year-on-year basis. Now, obviously October was quite a long time ago. Official stats do take some time to come out, but we have had some independent updates on house prices since. I think probably the most widely followed kind of house price index is the one that Halifax publishes. And that showed that there was a further deterioration in November. Now, again, we talked about the timing of the budget. That was right at the end of November. So, a poor kind of month for the property market wasn't a huge surprise in that context. But we've also had some Rightmove data for December to date, and that doesn't make for particularly encouraging reading either. So average asking prices were down 1.8% for November, and they were down 0.6 year on year. Now, as you said, rates are a key driver of demand in the property market because they affect the affordability and the availability of mortgages. So the rate cut that's been announced can certainly help with that. But I think it's worth noting that yields on 10-year gilts are still pretty sort of stubbornly high. And that's another kind of key driver of mortgage rates, particularly, for those who are looking for the certainty of a longer term fix for their mortgage.
What about shares in house builders? Obviously, they're very sensitive to both interest rate trends, also to these monthly figures that we get from various sources about what's going on with actual prices, whether it's a buyer's market or a seller's market.
Yeah, exactly. Yeah, no, that's very true. And they've struggled in 2025, really. I mean, they've basically gone nowhere, which when you compare that with the FTSE 100 as a whole, say, which is up more than 20%, that's not an impressive performance. And that kind of, I guess, matches what has been a pretty stale property market. There's been a few signs of life recently, partly linked to sort of hopes for rate cuts, but also there's been some news about planning reforms that could be quite helpful for the industry. So for years, I've covered the house building sector for a long time, and you could see them consistently complain about obstacles in the planning system and that being a real issue in terms of building the number of homes that politicians want them to build and they want to build themselves. But they've given a bit of a kind of cautious welcome, I think, to what the Labour government has been trying to do. And these latest proposals do look like they might make a bit of a difference. So there's going to be this permanent presumption in favour of a suitably located development. So basically, if a developer ticks all the boxes and they're building homes in the right places, they're going to automatically essentially gain permission. So local authorities, so-called NIMBYs, they won't really be able to do anything about that, but these developments will go ahead. There's also, within these proposals, some interesting stuff about supporting development around stations, and also for making it easier to build on green built land, which has previously been developed. So all kind of put together as a package, I think that is, a positive development for house builders in terms of being able to build a higher volume of homes. Although, I think time will be the real test to see whether, it has made a tangible difference.
And what about the outlook for year ahead? I think it's looking quite brighter for, obviously you've got a government that's pro-housing, you've got rates trending the right direction. What does that suggest a better year for the property market?
I mean, possibly, but I think it's fair to say that if you look at sort of people who are observing the property market, they're not getting carried away. So if you go back to Rightmove that we discussed earlier, they're expecting growth of 2% next year. And banking and finance industry body, UK Finance, is actually expecting the number of house sales to fall modestly next year, thanks to pressures on affordability. So despite rate cuts, I think people are still going to find it difficult to afford the kind of mortgages they'll need to buy the houses they want. Now, the UK is a market which has quite supportive supply and demand dynamics. So Britain's not building homes fast enough, essentially, and it hasn't done for a long time. So that probably provides a bit of protection against a big property market slump, but doesn't look like there's massive excitement about the property market in 2026, really.
Okay. Let's turn our attention to how markets have actually performed in 2025. I think so, Tom, if I was more technically minded, I would press a button now and it will play the sort of the countdown chart music from Top of the Pops. But I'll be honest, I've no idea how you do it. So let's pretend it's playing in the background as I sort of round up the hit parade for financial markets. So, Tom, you got any idea where in the world, in local currencies, could you have made the most amount of money this year?
I'm going to guess Japan off the top of my head.
That's a really good guess.
Okay, good.
It comes in very high. It's not quite at the top, but
Right.
let me just run through. So number 10 is in. I won't give you all the numbers, but you've got France at 10, China at 9, Switzerland at 8, and then you got a couple of the American indices, S&P 500 and Nasdaq composite. So S&P 500, you've made just over 17%. Obviously, that sounds pretty good. But then if you think that above that is various parts of Europe, which doesn't normally. You wouldn't expect them to do more than America. It just goes to show how we've had a sort of a shift in dynamics this year. So at number 5, you've got Germany's DAX, just under 21%. UK, FTSE 100, 22.6% total return. So obviously that includes dividends. That's brilliant, isn't it? I mean,
yeah, really impressive. I mean, it's got to be the best for a long time, right?
Very, very much so. So it goes, anyone sort of keeps churning out the old arguments saying, oh, it's really boring, blah, blah, blah. It's actually been a brilliant place to make money. And we've talked about this lots on the podcast if you go back and listen to old episodes. And we no doubt will continue to do so as well. Number 3 is Japan, as you guessed number 1. We're almost there. So 23.8% from the Nikkei. Number 2 is Hong Kong Hang Seng, 25.8. But the top was Brazil, the Bovespa, so 31.8%. So Brazil, I mean, I'm not an expert on Brazil. I presume this stock market is driven by soft and hard commodities.
Yeah, I think it's commodity driven, isn't it? I think that's probably been what's behind it. But yeah, I am not an expert either, so that's as far as I'm willing to go in terms of explaining that one. Thanks for that, Dan. Before we dive into some of the individual stocks that did well or lagged the market, let's bring on our first guest. So Dan recently caught up with Ryan Hughes. He's the managing director of AJ Bell's investments arm, to get his thoughts about markets in 2025, the importance of spreading your risks, and how he is feeling as we approach 2026. Let's hear that interview now.
Very pleased to be joined by Ryan Hughes, AJ Bell's managing director for the investments division. So Ryan, great to see you.
Hi Dan, thanks for having me.
Can we talk about diversification? Whilst markets have had a pretty good time this year, it does sort of suggest that spreading your risks is a good way to go about investing. Just because something's doing well now doesn't mean to say it's going to be doing well around the corner. How are you sort of feeling about diversification at the moment? Really important to be doing it?
Yeah, I think for most investors, diversification's your friend at all times. It's very rare that a single asset class or a single market will be the dominant one. I mean, we have seen that recently with the US and a narrow bit of the tech market doing incredibly well, but that's actually quite unusual. And of course, if you had just piled all your money into that, yes, you would have done well, but you'd have also been carrying quite a bit of risk if you'd been wrong. As we've seen this year, when we've looked through markets, it hasn't just been the US that's done well. In fact, the UK's done better than the US, Europe's done better, China's done much better, and therefore, even if we just think about equities, being geographically diversified has been really, really helpful there. And that's often the case. Say it's rare that we get such a one dominant element. And so diversification, it's, as I think it was Markovits said, the Nobel Prize winner said it's the only free lunch in investment. And I think he's right.
So we talked about equity, stocks and shares. There's a little uncertainty as we towards the end of the year. People not sure about what, can this rally keep going? But actually, if you look at the bond market as well, there's a bit of uncertainty there. Obviously, the expectations for interest rates still seems to be changing, whether that's the UK, the US. What's sort of your positioning at the moment with fixed income? Where do you think you should be having a look at?
Yeah, I mean, I would perhaps be slightly flippant and say, tell me a time when there hasn't been uncertainty, because I think there's always something. And I think naturally, as investors, you focus a lot on what could go wrong. So I'm not saying we're necessarily always glass half empty, but I think you need to have an eye on what are some of the risks out there and thinking about markets. And then if we think about the bond market is so intertwined with politics, and always dangerous talking about politics, I think, in any discussion these days. But when you're thinking about fixed interest, you cannot get away from politics. You cannot get away from government policy, cannot get away from central banks, inflation, interest rates. They're all intertwined. And so it has been volatile. And we've seen here in the UK as the government has talked about various tax rises. We've seen the bond market maybe do quite well on the back of some rumours. and then do quite badly on the back of other rumours. And so all investors are looking very, very carefully at this. We generally have been worried about the stickiness of inflation for quite some time. In fact, all the way through 2025, we've had some positions in the AJBL funds where we have been focused on thinking about how do we make money if inflation is higher than people expect. And actually, throughout the course of most of this year, it has been higher than people expect. So that's been a good positioning for us. We've been worried about lending money to the government for a long period of time, given the interest rate risk that carries. So we've been much more focused on lending it to them for a short period of time. And again, that's been a good strategy as we've been reasonably well paid for that, but we haven't had to take huge amounts of risk to get that return. So there's a few different ways we've been playing that there, and there's other areas of corporate bonds and emerging market debt that have actually done okay as well this year, but really the focus has been on managing your interest rate risk and managing your inflation risk.
If you look at the whole year of 2025, loads of noise around economics, politics, trade, and everything. So, how do you keep a clear head throughout all of this and sort of stay focused?
Yeah, it's difficult some days. You think back to April when the tariffs, Trump announced his tariffs. When markets are selling off 5%, 6%, 7% in a day. It's hard to keep a cool head in that, but that's our job. It's what we're here to do, and so we've got to navigate our way through it. I think also our experience shows us, and I've been doing this for 25 years now. If you think back to the last 25 years, there has been many momentous events in politics and economics and life in general that have influenced stock markets and economies, and therefore it's about cooling on that experience, staying calm, staying rational. Because generally when you make irrational decisions, particularly with money, they often tend to be bad decisions. So we want the team to stay focused, stay rational, be objective and review the data, and try and take your emotion out of these. Because who would have thought that only a couple of weeks after Trump announced his tariffs in April that the S&P would then rally and absolutely fly and make back all the money that you lost in those couple of weeks and then made you a whole load more. The whole emotional side of things was probably telling us, how's the world going to cope with this? It's going to be really difficult. So maybe the behavioural side would say, be cautious. But actually, turned out the right thing to do was actually say, this is an opportunity to buy in and make some more money for clients. So you've got to manage those emotions, be aware of your own behavioural weaknesses, and try not to let those biases dominate your own thoughts and your investment decisions.
So 2026, just around the corner. Is it giving you nightmares at night, or are you feeling quite optimistic, ready to take the challenge of the new year?
Thankfully, I'm a pretty good sleeper, but it doesn't mean I don't, think about things. And certainly, I wake up an early riser, and I wake up early thinking about lots that's going on. So 2025 has been a very good year. People have made good money in 2025. Now, can we expect that to continue to be as strong 2026? I think, given where markets are, that feels perhaps a little bit challenging, but it's not all doom and gloom. There are lots of great companies out there that are cheap, they are unloved. There are companies still making great profits and paying healthy dividends, and we shouldn't get away from that fact. The yields on bonds are quite attractive right now, I think. So there are areas in the market where money can be made, but as ever, every single year there are bumps in the road. There's no such thing as the perfect year where we don't face some challenges, and there's no such year where the market doesn't have some kind of at least small pullback there. So I think we have to expect more of the same next year. Politics feels like a volatile beast right now, and it's influencing markets and economies much more, it feels like, than perhaps it did historically, and therefore I suspect we'll have a little bit more of the same.
Fingers crossed it works out all right in the end. So Ryan, thanks ever so much for coming on the podcast. Brilliant to talk to you.
Thanks for having me.
Thanks again to Ryan for coming on the pod.
So I promised we would dive into the best and worst performing stocks of the year. So Tom, shall we start with something shiny?
So Fresnillo and Endeavour Mining are two of the really sort of top performing shares on the FTSE 100, particularly Fresnillo, which is by quite a distance the top performer on the index. And they benefited from higher precious metal prices. Both of these are precious metals miners. Now, they've made some operational progress, which has also helped. What I think is interesting is that Fresnillo has quite heavy exposure to silver as well. And, people will probably be familiar with the fact that gold has done exceptionally well this year. they might be less sort of aware that silver has done even better than gold. So it's more than doubled in value this year. So that has been a kind of a key driver behind both these companies having very, very strong share price performances in 2025.
I want to talk about Lloyds as well. I mean, so we talk about Fresnillo being, the top FTSE 100 performer. Lloyds is one of, if you look at the top 20, Lloyds is, quite high up there, 80% return in the year. So you don't expect that from a bank. No. But one thing that's quite interesting is obviously, this is simply a business that's just got on and done its job. It's growing well. It's keeping a lid on costs. It's obviously benefited from interest rates being relatively high, but that's not the only reason. It's just simply this is like a business just getting on with it. Investors have been looking at the UK stock market in general for opportunities. These banking stocks haven't really been they're not expensive at all by any means, and so it's just really has sort of caught the market's attention this year. I don't think you can expect 80% from bank every year. But certainly, I think if you've been in that stock, and a lot of people are in that stock, really widely held in ISAs and pensions, you should be sitting pretty happy as we're just approaching Christmas.
Yeah, I mean, it's reward, isn't it, for being quite patient, I suppose, because if you've stuck with it for a long time, you'll have had some years where it's been a pretty disappointing performance. So, good for those people that they've stuck with it and they've been rewarded. Now, in terms of some of the other really top performing stocks on the UK market, there's two that will I think it makes sense to put together, which is Babcock and Rolls-Royce. Rolls-Royce has been one of the top performers ever since the chief executive, Tufan Erginbilgic, took over, which was the beginning of 2023. But it's done really well again this year. Now, people might remember that early this year, we saw a big spike in defence-related stocks, and that was mainly pegged on a shift in foreign policy in the US, which meant European countries would have to spend a bit more on their own defence. And both Babcock and Rolls have exposure to this theme. So, they've really benefited from that. But they also have exposure to the nuclear sector, which, for a long time, people were had safety concerns about nuclear, and it felt like nuclear was a bit kind of in the doldrums. But it's kind of been energized, pun intended, I guess, this year. And that's beneficial for Rolls and Babcock because of their their various kind of expertise in this area. And Rolls's exposure is through what is still quite an early stage part of their business, but this small modular reactor arm. And this is seen as a sort of cheaper and faster way of bringing nuclear power on stream. And nuclear is seen as a sort of relatively clean and reliable source of energy that, in an environment where demand for power is really increasing, particularly that associated with AI, could be quite important.
Yeah, I think it's interesting. I mean, obviously, just as we were recording this, there was the day earlier, there was a bit of a wobble in both their share prices when there was a sort of speculation that the Ukraine, Russia might reach a peace deal. And it kind of shows that those stocks have gone up because of the tensions in there. But so, the fact that the market starts to take profit potentially is what we've seen. It's just an interesting trend to watch, I think. So.
Definitely. I think you're right. I think that will be something to watch for 2026 because there was so much kind of excitement around sort of this idea that European countries would be spending more on defence. And that is kind of happening. But quite often when in these situations, things overshoot, don't they? So yes, I think you're right. It could well be that in 2026, we see people maybe get a bit more, I don't know, not pessimistic, but perhaps a bit more realistic about exactly what the benefits to these companies might be.
Yeah, I think it's just also could be a slight case that there's so much potential good news already factored into their share price.
Exactly.
Talking about switching to the UK retail, we want to talk about Next returned 44% in the year. I don't think anyone who follows the stock market will know that Next has got a track record of under-promising, over-delivering. The mystery to me, Tom, is that every time I go into their shops, I don't ever see anyone actually at the till. Whether it's just a case that people do all their shopping, they just pick them up as a click and collect. I find it strange, but it's like, and I was talking to a fund manager about this last week, and they were saying to me, like, well, I think you'll find if you go, like, it's always like the number one choice for parents wanting some nice quality clothes for their kids. You've got the basics and stuff. So, yeah, but obviously, it continues to deliver very, very strong.
Yeah, it's an exceptional company, I think. For a retailer, you said obviously it's, expect a bank to put up 80%, and whilst Next hasn't enjoyed sort of gains quite on that level, that's an impressive return, and I think it reflects the fact that it just gets most stuff right. I mean, it's interesting what you say about the stores. I think they do function. They have a dual function, don't they? Because so many people use their kind of next day delivery and kind of use them as a place to kind of collect their orders. So I think there is that element to the Next story for sure.
Yeah. Should we talk about a couple of US listed stocks? What sort of the ones have been catching your eye there for this year?
Yeah, well, one that caught my eye, partly because I think it is the top performing S&P 500 stock, is called Seagate Technology. Now, taken purely from the name, you might guess this has some kind of maritime association, but actually it's a data storage firm in the US, and data, AI, these two things sort of go hand in hand, and it's benefited hugely from the increase in demand that we've seen associated with the expansion of AI. So probably a bit of a lesser known AI play, but it's one that's done exceptionally well in 2025.
I wanted to quickly flag Applovin, which always makes me chuckle. It's like watching Superbad.
McLovin. Yeah, it made me think of that too.
But it's like, I was thinking, I don't, perhaps, I keep my eye on quite a lot of American ones. And this year, I've had to sort of familiarize myself with it. In a nutshell, it helps companies buy and sell adverts in smartphone apps. So it used to be involved in much more sort of mobile gaming stuff. That business was sold. And it's, basically come out with some really interesting stuff. Obviously, people are getting excited about what it's doing with AI. More recently, it was one of the companies who's expressed interest in buying TikTok's non-Chinese operations. So, but yeah, obviously that's to more than double your money. Pretty interesting year for anyone who's held those shares.
100%, yeah. So that's the positive out of the way. But to balance things out a little bit, it's probably fair that we talk about some of the stocks that have done particularly badly in 2025. And I'm going to start with WPP. So probably a lot of people listening will have heard of this business. It's a global advertising business. Large consumer names spend a lot of money with them, pushing their products, services, brands, etc. And historically, it's sort of been seen as a bit of a bellwether for the global economy because it's got quite broad and deep operations. And essentially, if people are feeling confident about the economy, they're going to spend more on advertising. But this hasn't happened overnight, but the world has kind of turned for WPP, and it's struggling to remain as relevant in the current landscape, I think. So just to put that into context, this year, the company's forecast to post a little bit less than, it's about £11.7 billion of revenue. Now that's lower total than it achieved a decade ago, with lower margins and lower profit on top. So, it's a business that's kind of essentially going backwards, and it suffered a bit because you've got the likes of Google and Meta effectively eating its lunch because they're going direct and selling advertising to the big brands. So that, you've got the likes of Google and Meta effectively cutting in and selling advertising directly. And, you've had, what is not the most helpful economic backdrop, but it's also been kind of a victim of its own failure. And Mark Reed, who was the CEO until relatively recently, sort of struggled to turn things around after the founder, Martin Sorrell, left under a bit of a cloud in 2018. And now his successor, who is somebody who used to work at Microsoft, Cindy Rose, famous. She's only been in post since September, but she, has, in the short time she's been in the job, led the company to the indignity of being relegated from the FTSE 100. And is interesting and probably not that surprising that WPP is now being pegged as a takeover target, given it's in quite reduced circumstances compared to what it was.
You're mentioning about WPP kind of being like an economic bellwether. I want to point out Bunds as well, because it is seen as like a GDP plus style earner. So if the economy does well, it should be doing well, a little bit better than the economy. So that's you would have basically lost a third of your money if you'd bought at the start of the year. But Bunzl is an interesting business. So it supplies products to other companies that they need in which to do their day-to-day business, but it's not things that they actually sell to their customers. So I think if you think about clients might be medical centers, hospitals, or Bunzl's supplying like all the plastic gloves that they need into a coffee shop. If you see all the sort of the takeaway cups and stuff. So it's had a couple of bits of bad news this year, but one that sort of really stands out is that it's guiding for sort of lower operating margins, flagging geopolitical uncertainty, and I think margins are really important to a company like Bunzl. They're not very high, so the slightest drop in margin will have a big knock to earnings. So yeah, investors have definitely not really been very happy with this company this year.
No, I think it was one that you always had pegged as being quite boring and reliable, and it's been too interesting and not reliable enough, really, has it, in 2025. Another UK name that's really struggled is Diageo. So this is, you mentioned Guinness. This is the company behind Guinness, things like Johnny Walker whiskey, so it's a big alcoholic drinks business. And really, it's been struggling for quite a long time. Again, this isn't one where it's happened overnight. The late CEO, even Menendez, left in 2023 to be replaced by Deborah Crew, who herself has now departed. And it's been hit by things like shifting drinking habits. I think some of its acquisitions were perceived as being quite expensive, a bit more kind of some fashionable tequila brands and things like that. And it's had issues with inventory as well. But there was a bit of positive news for Diageo, I think, before. Certainly it was received well by the market before the end of the year, in that they've managed to persuade Dave Lewis, the market Mr. Fix-It, I guess, that the guy who turned around Tesco, to come in as CEO. So that has given people a little bit of encouragement heading into 2026 that might be a better year for Diageo.
Yeah, I mean, another one that caught my eye was Auto Trader. Online platform, help sell cars. You'd think that it would just quietly tick over. Actually, the share price did pretty much nothing all year until its results come out in November. Then they've been falling ever since then. If you think about Auto Trader, it really wants to have high volumes of transactions on its platform. Most of the the average revenue per retailer growth came from price hikes, more dealers signing up to new products rather than bigger stock volumes or premium listings. So its model works by, it needs dealers to be advertising on there, and that them to be wanting to do lots of stuff. So I think that we've had a really big derating its shares. I had a quick look before we were recording, and if you look back in history, Auto Trader used to trade around 22, 24 times forward earnings. That rating now sits at 16 times. That's a big dial back from where it stood. So I think that you've had disappointing results, but equally this derating in its shares is what's really hurt investors this year.
Yeah, that's really interesting. Turning kind of back across the Atlantic to look at some of the US stocks that haven't done so well. So one of them is Strategy Inc. So this was formerly known as MicroStrategy. Historically, it was a kind of software business, but more and more, it's essentially become a proxy, or a kind of a lookalike for the Bitcoin market. And that's because it owns about 670,000 Bitcoins, and that's 3% of the maximum supply. So Bitcoin's obviously limited, and the absolute maximum supply that there could ever be of Bitcoin, it owns 3% of that. Now, that was all well and good when Bitcoin was going up, but obviously it's left it very vulnerable to the recent sell-off that we've seen in that cryptocurrency. And its model was kind of dependent on having a rise in share price, which in turn enabled it to issue stock to buy more Bitcoin. And that model's broken down, obviously, with its share price reacting to the fall in Bitcoin. And I think it was quite notable and certainly sort of raised some eyebrows that the company announced the establishment of a reserve in good old-fashioned dollars to cover the next 2 years' worth of its dividends. So, yeah, not a happy 2025 for Strategy.
I think we just wrap it up by talking about Lululemon, posh leggings. I mean, this is like, nearly halved. If you'd bought at the start of the year, you'd lost nearly half your money by the end of the year. His problems didn't start this year. Go back last year, it was stocking the wrong things, the wrong colors. It then had to pull its breeze through product line, had lots of negative reviews from customers saying it's really uncomfortable. This year, dealing with really fierce competition, having to deal with high costs, hit by tariffs that ended, and the ending of sort of the so-called de minimis exemption. So it was like a former duty-free loophole for low-cost goods coming into America from countries like China, and where, if you think about lots of Lululemon products are made in Asia. So really, we've had a pretty bad year. And just the other day, you said that they're going to get a new chief executive in. So yeah, maybe this sort of athleisure thing is popular, but there are so much choice. So the idea of people going to Lululemon like they did maybe 2, 3, 4 years ago, not quite the same. But before we sort of finish talking about stocks, I did want to touch on a little bit of AI news, because this is a hot investment topic. And there's a couple of things worth just flagging. Tom, do you want to start off? So we had some stuff from Oracle the other day, which did cause a little bit of a market wobble.
Yeah, so there's sort of two kind of earnings reports that we had. I mean, and these have just fed into sort of existing concerns, I suppose, that people have had about AI. So, the market was getting quite jittery about AI. The amount was being spent on it, valuations in the sector, and particularly the companies that are kind of responsible for the infrastructure necessary for AI to grow. So, the one from the earnings from Oracle that that you referenced, which came in about a week or so ago, they were quite a bit weaker than people had been expecting. And investors were also spooked by its plans to allocate even more capital expenditure to AI at a time when, some of the companies that are spending a lot on AI have huge amounts of cash and massive balance sheets that they can fund these capital expenditures. But Oracle actually has quite a bit of debt. So I think, that's something that's worrying the market a bit. And then Broadcom, which I mentioned, which is a chip company, a bit like Nvidia, I suppose, on a very kind of basic level. Now, its numbers were pretty strong, but I think what was concerning the market was it was talking about margins falling because there are higher costs involved in, building AI related chips. So, yeah, I think, it's been a kind of theme of the latter part of 2025 that there has been a bit of a concern about, is there a bubble in AI and about valuations in this space. But yeah, these two bits of news from Broadcom and Oracle have only really reinforced those. So, followers of the sector will be hoping for something a bit more positive, I guess, in the early months of 2026.
So that brings me neatly on to a story I noticed in the Financial Times about investors seeking protection from risk of an AI debt bust. So what's happened recently is quite a lot of companies that are building out the infrastructure for AI, they've issued bonds to raise money to fund this work rather than just simply funding it from their own cash flows. Investors sort of a bit concerned about this, particularly because there's still uncertainty about when there's going to be positive financial returns from this spending. So there's been sort of a big increase in trading in these sort of insurance-like products. They're called credit default swaps, and I don't really want to sort of go into sort of Wolf of Wall Street or The Big Short situation where we're here trying to explain very complicated financial terms and easy to understand languages. I'll just say that they pay out when companies default, and so kind of transfers the risk of bonds defaulting from one investor to another. For the average person, you probably won't get involved in these things. So it's worth just knowing exactly what's going on with these trends. We will monitor this, and if we see that there's an increase in activity, we'll talk about it again in a little bit more detail on the pod. But it's quite ironic that just a couple of days after this article appeared in the FT about this sort of concerns about AI debt and related stuff, we had an IPO, a stock market debut of a company in China that does graphic processing units. So, and this is a company called MetaX, and its shares went up 692% in one day. And this is essentially sort of, we've had China this year saying we can do a lot of our tech stuff ourselves. We don't need the West. We've seen this with DeepSeek, cheaper alternative to ChatGPT. We've seen, obviously, restrictions on NVIDIA being able to sell its most advanced technology to China. So China's essentially sort of saying, like, we'll do this ourselves. So there's a lot more interest in what China's doing from tech perspective. So this MetaX up 692% in a single day. No wonder lots of people are starting to think more seriously, even more seriously, about have we got a bubble with AI? And if so, will it pop?
Exactly. Yeah. So we're very mindful of that. I think, we've been talking over the last few minutes about this potential for an AI bubble and what might happen if it bursts. So partly with that in mind, we sent Dan to talk to an expert in investment strategies that aim to preserve investors' wealth. Charlotte Yonge from Troy Asset Management has had an interesting year, as she now explains to Dan.
Well, I'm very pleased to be joined by Charlotte Yonge from the Personal Assets Trust and the Trojan Fund. Thank you very much for joining us. Hope you're well.
Yeah, very well. Thanks for having me.
Good. I've spoken to lots of fund managers recently who are either in sort of global equities, they're in tech stocks and stuff. Your sort of approach, you're sort of the more capital preservation, isn't it? Like trying to protect investors' money, but also grow it.
Yeah.
What has 2025 been like for you? Is it been, markets overall done quite well, but it's been quite volatile. So I presume that, have you actually had some, you've come into your element really when there's lots of uncertainty?
So I suppose there are two things. It's sort of how have we performed, have we protected, and have we grown, to your question. And in the sell-off during Liberation Day, the market at its sort of trough was down nearly 20%. We were down just over 2%. So that was relatively okay protection. We sort of shareholders and investors tend to be quite happy with that. Have we grown this year? Again, this is sort of to the end of October numbers. We were up just over 8%. And part of that, a big part of that has actually been gold. So gold's done really well for us. And the equities we own have been more of a mixed bag. So some have been really good, like Alphabet, which we were adding to in Liberation Day. So when that big sell-off happened, we were adding to stocks. So that's probably come onto it. But a big thing we've done is actually up our equity allocation this year. And since that day, Alphabet was on $145 on the 7th of April, 8th of April. It's now $300. So that's been the biggest single stock contributor. And there have been a couple of others almost as good as that. And then some of the more defensive companies have been detractors or just generally just a bit boring. So it's kind of been a tale of two halves, and our stocks are up about 10% year to date. So not as exciting as the market. But I think we're relatively, overall, that aggregate number is sort of in line with what we would expect.
Yeah, because I was looking at your portfolio in the top 10. It's got sort of bonds and gold, which is kind of what you expect. And I saw that you had Alphabet and Unilever. They sort of, they sort of stick out. I was expecting more of a sort of a sort of fixed income led sort of portfolio. Why have you got those sort of stocks? You think that they're good things to hold in the current environment?
Yeah. So our whole multi-asset approach, we have sort of 4 pillars to the portfolio: equities, bonds, gold, and cash and currency. And equities come first for us. So actually, we think buying great companies, but at good valuations, is the best way to protect and grow capital over the long run. But we do have that flexibility to lean out of the market. We don't get FOMO. So if the market's really expensive, we're quite happy to say, look, we're just going to miss out on the last kind of leg up in the bubble. But we take stock picking really seriously, and we've got a great team of stock pickers behind us trying to find the best companies. So really, and you mentioned kind of the Alphabet and the Unilever sticking out, they're quite different businesses, as you say. We're really just trying to find consistency, but also kind of durability of returns. And we actually think both of those, they're both staples companies effectively. They're every day. You use Google every day. You probably maybe use YouTube every day. A lot of people do. Yeah. But you also use Dove shampoo or Marmite. So it's actually that sort of staple stickiness, but also which we believe will grow.
What do you do in terms of if we get a market pullback? I think there's people are sort of slightly concerned about it. Should someone expect your type of investment approach to sort of come into its own, to really shine when more when markets are sort of like going through sort of difficult periods. I presume when markets are racing ahead, is it natural to sort of expect you to slightly underperform the market, but still do okay? Fingers crossed.
I think that's exactly it. So we quite boring. We get clients sort of, they know what to expect because they know us. Generally, our investors buy us to be boring, but we get a lot less attention when the Nasdaq's kind of, when Nvidia has great results, no one really wants to come to hear about Troy. But when we actually in April, we had a few meetings, and honestly, it was like standing room only in Liberation Day, just because people get nervous and they think actually this is something we want. So we're quite happy to be boring, as long as we do compound. And I think that's the important thing, is can't forget, we need to, and your point, we need to hold up much better than the market. We are long only, so we will probably fall if the market falls. But we need to protect, not only because a lot of people rely on us to do that in their portfolio, but also we want people to be able to access that capital. So for example, you've lost your job or you're a charity who's in COVID. We want people to be able to sell without crystallizing a big loss. And so holding up is really important for that point. It's also really important to psychologically put us on the front foot so that we can add to equities. So when the market's falling, in each of those instances, we are also adding on the way down. And this is kind of to your point, how do we perform in that environment? Well, let's just take COVID as a good recent example. Gold's helping us. Our dollar exposure then helped us. Today we have yen, which would also likely and did help in COVID. Our equity is a bit more defensive, but we're also adding to risk on the way down. So COVID, we fell, the market fell, I think in the UK about a third. Our portfolio fell just over 9%. And we, on that drawdown, were adding. So we went from 30% in stocks to about 45 in the space of a few weeks, February and March. So that's kind of how we approach what we think is a potential dislocation in markets, have that resilience, but then we're also thinking, okay, well, what are we going to buy when things get cheaper? We're thinking that step ahead as well.
So so in 2025, you say you've been buying some equities. I presume you already had the gold. Were you increasing your gold position in the year, or?
So we've actually been reducing it. Yeah. So and I say reducing it. Sorry, we've been taking profit. So we had 11%, 12% actually in gold at the start of 2024. If we'd done nothing, we would have about 20% now. As a risk management process, we reduce that as it goes up. We don't want to be that investor that gets more bullish the more the price rises. Yeah. So we've kept it effectively between 11 and 12. We still think gold's got a way to run. We still think the debasement of fiat currencies is just happening. But also we can see central banks are allocating to gold and away from dollars on a kind of multi-year trend. So we want to have gold. It can be volatile in the short run. So we don't want to have too much.
What have you been slightly taking some profit on gold? Where have you been recycling that money then?
Yeah, so we've put that bit more into equities. So we started the year with just under 30% in stocks, and we now have just over 40. So we've put over 10 percentage points into stocks across a host of existing but also new companies. And again, this kind of speaks to a lot of companies are slightly out of favour just because they're a bit boring and they're not in the Nasdaq or in the Mag 7. And we really, looking for long-term quality. So, for example, healthcare businesses. We've invested recently in a company called Alcon, the biggest ophthalmology company. If you've used their contact lenses or if you've needed cataract surgery, you've probably used Alcon's products. That's got a very long runway for growth. Yeah. It's very consistent and defensive, but it's just a bit boring.
What about fixed income then? Bonds, is that good? Obviously there's some interesting yields out there at the moment. Or are you sort of cautious towards bond markets at the moment?
Yeah, so we're cautious on duration. So we like the fact that interest rates have risen. We have short duration US government bonds. What we are nervous about is that there is a lot of debt out there. The fiscal deficit is obviously growing in the good times. So what are they going to do in a recession? And we think that at some point the bond market will respond to that and will demand a higher cost of capital on that sort of 10-year duration, a 5-year, 10-year. So there's just a risk if you own anything long dated that you could lose temporarily or for any sustained period. We don't know how this plays out, but we don't want to be there for when that volatility strikes. if you own short duration, you're sort of locking in a return to maturity. You're going to own those bonds to maturity, and they're going to be less volatile if interest rates and yields rise.
Yeah. So, I mean, just generally, your sort of type of investment approach obviously should resonate with someone who's a little bit more cautious. But how do you see it within someone's portfolio? Do you think it plays a role alongside something else, or do you think you see people trying to time the market and think, okay, markets look a bit wobbly, I want capital preservation, but then I sell out when market's looking good?
Yeah, we always say to people, like, we can be the kind of part of your portfolio that you probably don't think that much about, because we are doing the asset allocation, to your point. We're thinking about leaning in more when we think opportunities are attractive. So it is quite a sort of leave alone part. It's always, I think, good for people to own more than one fund, so that when those inevitable periods where we do look boring, they've got something else that's doing something quite different. And we are different to most funds, so it does tend to sit alongside perhaps, a slightly more red-blooded equity mandate.
Yeah. Oh, Charlotte, thank you so much for joining us. It's been really good to talk to you.
Thank you for having me.
Thanks again to Charlotte for talking to us. Right, to round things off for the podcast for this edition and also for the year, we've got the final interview from AJ Bell's recent Investable conference, and it's with our Chief Executive, Michael Summersgill. Dan talked to Michael about a topic we're passionate about, which is getting more people interested in saving and investing. And Michael had some pretty fascinating things to say, as you will now hear.
Well, I'm very pleased to be joined by Michael Summersgill, Chief Executive of AJ Bell. Michael, good to see you.
Likewise, good to see you, Dan.
Well, I think it's probably a really important thing to start with. AJ Bell has actually been petitioning the government to try and stop fiddling with pension rules. So I just sort of asked this question. If there were no changes to pension rules, everything was kept same so people know what's going on, do you think that actually that could have a significant impact on, people saving into pensions, people saving up for their retirement?
I do. Maybe if I just step back and cover what we see as the issues and what we're asking for. So the way that the budget has been handled over the last 2 years, there's been this long period leading up to it where there's been this void and therefore uncertainty, and that gets filled with speculation. And with pensions, I think that's particularly damaging because it's such a long-term decision that you're asking people to make. You're asking people to defer some of their income, and in return, you're deferring the taxation on that income. That has always been the basic understanding. And there are other benefits as well, namely tax-free cash, the 25%, with other restrictions around that, but roughly 25% that you can withdraw tax-free. When you start creating uncertainty around those key aspects of the pension saving system, of course, it causes people who are already in the system to have doubts about whether they're doing the right thing, whether the money that they thought they had, the retirement plans that they had, are going to survive any tinkering that may come the way of pensions. It creates uncertainty, and it's, like I say, it's such a long-term decision that you can understand people then becoming nervous about it. If you look at some of the most successful policy interventions of recent times, I think the auto-enrolment has been one of them. So creating stability, then creating those nudges to get more people in investing through their pension is the combination that's required to ensure the long-term success of the pension system. Whereas you create that uncertainty, and at present you've got a landscape where people's social media feeds are full of scaremongering around pensions and people playing on the fact that there is such uncertainty around the rules. You've got to take that out of the equation.
So obviously we talked about pensions. What about ISAs? Do you think there's anything wrong with the system, or any certain elements that could be improved?
The ISA landscape has definitely become too complicated over time. I mean, let's start with the basics. Like with pensions, it's a brilliant product at its core. It's a fantastic product, the ISA, but it's definitely become too complicated over time. I think it's been a victim of its own success and its relative legislative simplicity. A number of different governments, a number of different chancellors have been unable to resist the urge to tinker with ISAs and to deal with the problem of the day as they see it with a new ISA, an amendment to ISAs, and it has definitely become too complicated over time. We've been calling for simplification. The other big problem that we see with the ISA landscape is this siloed nature, specific products for specific purposes, and we think actually removing all of that and getting to a single ISA gives the best possible chance of people investing or saving. Cash and stocks and shares can be the right asset classes for people at different times, but it depends what their objective is and where they are in life as to what the right balance for them would be. If you have a single ISA, then as a provider you're able to have that conversation with the customer, and particularly with the targeted support rules coming into existence, that will allow providers like AJ Bell to have a better, more structured and more helpful conversation with the customer and make sure that they're using the ISA in the way that's best for them. So I think that the complexity that has crept into the system needs to be removed, and removing that siloed nature of specific products for specific purposes. Those are the issues that I see with the ISA landscape.
I mean, what do you think might be holding people back from investing more? Do you think it's is it just simply a lack of money, or is it actually a lack of understanding about just general sort of personal finance basics?
Okay, I think it's both of those things. We can't sit here and pretend that this is for everybody. There's a whole range of income and wealth distribution in the country, and there are people for whom this is not a relevant service. They're never going to have the excess income, the excess capital to be able to save and invest over a long period of time. So there's definitely a money aspect to it, but there's, for the vast majority of people, there will be some relevance at some point in their life to these sorts of products, ISAs, pensions and the like. And there is the complexity of the landscape and therefore people's confusion and uncertainty and nervousness about interacting with it. The mistake that the industry often makes there is then to go to education and financial literacy. Financial literacy is inadequate. We need to educate people. And look, I'm not saying that there's not a case to be made for that, but there's also lots of long-term studies that have been done in other countries that show the lack of effectiveness of interventions like that. The intervention, i.e. the provision of education, is so far away from the point of use, the point in an adult's life when they will actually rely on that information, that the intervention becomes hugely ineffective. The key is to simplify the landscape as much as possible, hence previous comments about ISA simplification and stability around pensions. You need to make it as simple as possible so that people can, with the minimal possible interaction, actually get a reasonable outcome for themselves.
So obviously we're sort of winding down for the year now, but people's minds are now already thinking about 2026. What's sort of filling up your agenda already for the new year?
Okay, so at home, my good wife has been booking a number of holidays. That's filling up the agenda for 2026, which is great. We've got a young family, so it's always good to have those plans for the year ahead. Sticking with life at AJ Bell. Although there's probably a few things there, you're probably getting a sense of frustration from me around some of the topics that we've talked about, because I do think there's so much that can be improved, and I think there's some bad moves being made by policymakers at present. But there's a huge opportunity in the industry for us as a business to continue growing, as we have done for years and years now, to offer more help to more people over the long term. And I think there's an opportunity to get better outcomes for customers as well. So we're still investing in the business. We're investing significantly more now than we were a number of years ago in our brand, in our technology, in our products, and improving the business. And I think I've got a great team around me at AJ Bell, a very supportive board. So looking forward to continuing with that work through the course of 2026 and beyond.
Fantastic. Well, Michael, thanks you very much for coming on. Great to talk to you.
Thanks, Dan.
Thanks again to AJ Bell, Chief Executive Michael Summersgill. And that wraps things up for this episode of the podcast.
I just want to say thank you to everyone who's taken the time to listen to the podcast or watch the videos on YouTube and Spotify this year. We're really grateful that you give us this ongoing support, and we do hope you tune in when the podcast resume at the start of January. Till then, have a great Christmas and New Year's celebrations, and we'll catch you next time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.